Welcome to This Explainer. I'm absolutely thrilled you're here today for this financial consultation. We're going to be diving into a topic that touches literally almost every purchase you make, yet somehow it remains entirely hidden in plain sight. We are talking about Indian credit card economics and the MDR reward structure. I promise you, by the end of this, I'm going to reveal the exact hidden mechanics of who really funds those business class flights, the airport lounge access, and those massive 10% cashbacks. It's a fascinating system, and honestly, you're going to look at your credit card in a completely different way after this. Let's dive right in.
So let's start with the big question. Who is really paying for your free lounge access and that sweet 10% cashback? Look, we need to shatter a major illusion right away. Your bank is not giving away these freebies out of sheer generosity, right? They are highly profitable businesses, not charities. When you get a complimentary hot meal at the airport, somebody, somewhere, paid for it. And this sets up the central mystery of our explainer today. If the bank isn't losing money on these perks, where exactly is that cash actually coming from?
Well, the answer comes down to just three little letters, MDR. That stands for the merchant discount rate. Now, what is that? It's simply the fee a merchant pays to their acquiring bank on every single card transaction. I want you to think of the MDR as an invisible toll booth. Every single time you want to drive your money down the highway of digital payments, a toll absolutely must be paid. But here's the kicker. You, the driver, you don't pay the toll. The merchant pays it. And understanding that dynamic is the absolute key to figuring out why you earn reward points at all. Let's make this concrete and trace the exact step-by-step journey of a single rupee, just to see how this all builds up. Imagine you swipe your premium card for exactly 1 rupee. Step 1, you are billed 1 rupee. But the merchant, they don't get that whole coin. Those invisible toll booths activate immediately. Step 2, your issuing bank takes a cut, which is called the interchange. Step 3, the payment network takes what's called an assessment fee. Step 4, the merchant's bank takes their own processing cut. And finally, step 5, the merchant receives whatever is left over. So out of your 1 rupee swipe, the merchant might only actually see about 98 paise. Those missing 2 paise? That is the MDR, and that is exactly what funds the entire ecosystem. Okay, so what happens to those 2 paise we just shaved off your transaction? It doesn't just get split up evenly. Your issuing bank gets the absolute lion's share. We're talking about 78% of that total MDR fee. The network gets roughly 14%, and the acquiring bank gets about 8%. And here is the absolutely crucial takeaway from this breakdown. That massive 78% slice going directly to your issuing bank, the interchange, is exactly what pays for your rewards. The bank basically takes a cut of the merchant's revenue, and then they share a tiny little piece of it back with you. Which brings us to a pretty dramatic mathematical reality, 0%. In India, government payments, like paying your income tax or your passport fees, have a mandated MDR of exactly 0. Think about it. On the government highway, the government completely refuses to pay tolls. And because the MDR is 0, the interchange is 0. With 0 interchange, there is literally no money to share with you. This is exactly why your super premium, expensive credit card will never, ever earn a single reward point on your tax payments. And this beautifully illustrates the mechanical correlation between where you shop and what you actually earn. Your reward rate almost always follows the merchant's MDR rate. High-margin businesses, like fancy dining and restaurants, they typically pay a really high toll, usually between 1.8 and 2.5%. Because of that, your reward potential there is very high. Now, contrast that with fuel stations. Oil companies operate on incredibly thin margins, so their MDR toll is strictly capped at around 0.5%. You simply cannot squeeze massive premium rewards out of a capped fuel station. The math just doesn't work. Now let's contrast the major network players in this space. You've got Visa, MasterCard, and RuPay, and they operate on what's called an open loop system. Essentially, there are 3 totally separate parties sharing the pie: the issuing bank, the network, and the acquiring bank. But then you have American Express. They operate on a closed loop system. In their model, American Express is the issuing bank, they are the payment network, and they act as the acquiring partner. They literally are the entire loop. And because American Express owns that whole loop, they get to capture both the interchange and the network fees. Historically, they charge merchants a much higher MDR toll for this, sometimes going all the way up to 4%. Now, this higher revenue is exactly how Amex funds those highly premium, non-expiring rewards and amazing lounge access. But there is a direct trade-off here. Because the toll is so incredibly high, some smaller merchants simply refuse to let Amex on their highway. It's just a rational business decision by the merchant to avoid paying that premium fee. On the flip side of that, we have the RuPay dynamic.
RuPay is India's domestic network, and it's backed by the government specifically to increase financial inclusion and lower digital payment costs for small businesses. And honestly, it's highly effective at doing exactly that. However, mathematically speaking, if you intentionally lower the toll booth fees for merchants, you inherently lower the interchange that goes back to the banks. Less interchange simply means less money available to fund your rewards. It's an unavoidable mathematical reality. Lower merchant costs structurally equals lower reward points for you. All right, let's move on to Section 1, the co-branded magic. How Swiggy funds your 10% cashback.
So, if the standard MDR maxes out around 2.5%, how on earth are we getting double-digit returns? Well, let's deconstruct a standard 500 rupees Swiggy order using their co-branded card. Normally, the bank might only earn about 9 rupees in base interchange, which is nowhere near enough to hand you a 50 rupee cashback. The secret? Swiggy actually pays the bank a co-branding fee for that transaction. Because Swiggy normally has to spend hundreds of rupees on advertising just to acquire a new customer, subsidizing your 10% cashback is simply cheaper, much more efficient marketing for them. The brand is paying for your loyalty, not the bank.
Okay, now for some pretty provocative insider terminology. Behind closed doors, banks basically categorize their customers into two main buckets. First is the deadbeat, and ironically, this is the responsible customer. This is the person who pays their bill in full every single month, earns all the rewards, but yields a very modest profit margin for the bank. On the other side, you have the revolver. This is the customer carrying a balance month to month at a steep 3.5% monthly interest rates. The revolver yields triple the margin for the bank. The hidden truth of this entire industry is that the responsible deadbeats rewards are heavily, heavily subsidized by the massive interest payments of the revolver. So, what is your actionable homework from our financial consultation today? Well, now that you know your rewards depend entirely on the merchant's MDR category, you really shouldn't be flying blind. Before making any significant transaction, I highly recommend using Rokdaa.com, that's spelled Rokdaa.com. Use the merchant lookup tool to essentially peek behind the curtain and ensure the merchant's category actually yields the rewards you're expecting. Please, don't waste a massive swipe on a zero-yield category. So we've traced the journey of the money, we've uncovered the invisible toll booths, and we've revealed the true source of your card perks. I want to leave you with a provocative question about your own financial profile. When your bank looks at your account, who do they actually see? Are you the highly profitable revolver funding the whole ecosystem? Or are you the deadbeat strategically cashing in on all those sweet rewards? Think about it the next time you swipe. Thank you so much for joining this explainer, and stay financially curious.